Hi, I'm going to be doing a demonstration of a homework problem, CP4-4, but before we get started, I'd like to take a moment just to review the accounting cycle. And if you haven't printed out the worksheet, please do so because we'll be using it in our demonstration problem. Okay, now hopefully you've either read Chapter 4, you've watched the mini lecture, or you've taken a look at the concept overview video so that you're familiar with why we do adjusting journal entries. But let's remind you of where we are in the accounting cycle. On a day-to-day basis, business transactions occur, we analyze, then we journalize them, which means we create journal entries, and then we post those journal entries to our T accounts in our general ledger. And then at the end of the accounting period, we prepare a trial balance to make sure the accounts with debit balances equal the accounts with credit balances in total. Now, up to this point, we went directly to the financial statements, but in Chapter 4, we learned that there are adjusting entries that are necessary before we do our financial statements in order for those financial statements to be correct. So what we're going to be doing now is we're going to be approaching those adjusting entries as an accountant would by taking a look at that trial balance. Sometimes this is called the unadjusted trial balance because it's before the adjustments have taken place. Okay, so we'll be doing CP4-4, and this is for Golf Academy. Golf Academy provides private golf lessons. Its unadjusted trial balance at December 31st, 2018, and selected account information follows. Now, before we do anything with the adjusting entries, what this problem intends for us to experience is the difference between the unadjusted net income and the adjusted net income. In other words, what would happen if you prepared your financial statement before adjustments, and then what would the income statement look like afterwards? So they want us to do an unadjusted net income statement for the year ended December 31st, 2010. We would never do this in real life because we know those adjustments are necessary. Otherwise, the statement will be incorrect, but they just want to prove it to us. So our formula is revenues minus expenses equals net income. Let's find our revenues. Our trial balance is in this following order: assets, then liabilities, then the equity accounts, then revenues and expenses. So there's only one revenue account here, service revenue. So we'll write that down. And the amount is $51,500. Now our expenses, we list them from greatest to least. We only have two: salaries and wages expense and supplies expense. So list those under the expense heading. That's $36,100 for salaries and wages expense, and for supplies expense, $2,400. And if we add those two up, our total expenses come to $38,500. To find our net income, we take our revenues and subtract our expenses. Total revenues are $51,500. Total expenses are $38,500. Subtract, and that gives us our net income of $13,000. And it's a net income because our revenues are greater than our expenses. If the expenses were greater, it would be a net loss. Okay, now in Part 2, we're asked to name the 5 pairs of balance sheet accounts and income statement accounts that require adjustment and indicate the amount of adjustment for each. Okay, so we're going to start with each item of the trial balance and work our way down using the information provided on the right to determine if the account needs to be adjusted. Okay. Well, first of all, cash will not need to be adjusted because we would normally be preparing a bank reconciliation, which you're going to learn about in the next chapter, so we won't worry about cash. Supplies. It has a debit balance of $600. And in the further information, we're told based on account, only $200 of supplies still exist. So this amount of $600 is incorrect. It should say $200. So we need to reduce that supplies account by $400. So the balance sheet account that needs to be adjusted is supplies. And the related income statement account that needs to be adjusted is supplies expense. Remember, an asset is a future benefit, an expense is a used up benefit. So those supplies went from becoming assets to expenses because they were future benefits, and then they became used up benefits. And the difference is $400 if we only have $200 left. So the amount of the adjustment would be $400. Let's keep going. The next account is a liability account, deferred revenue. And remember, when we get paid before we provide goods or services, we can't call it a revenue until it's earned. So we put it in a liability account called deferred revenue. Of this amount, $3,000 was received for December lessons and $500 for January lessons. Now, this unadjusted trial balance is dated December 31st. So we're going to assume that since it's December 31st, the December lessons have been delivered and you've earned $3,000 of that $3,500. $3,500 represented both December and January lessons. The January lessons have still not been delivered, so $500 needs to remain in that account, but $3,000 were delivered. So the balance sheet account to be adjusted is deferred revenue, and the related income statement account is service revenue. And the amount that needs to be adjusted by is $3,000. Next account. Income tax payable. It states that the company has paid last year's income tax, but not yet this year's income tax. Well, we haven't even figured out our taxable income yet. So we have to wait with this one until we can determine what our adjusted net income is, and then we'll calculate our income tax expense and income tax payable. Under interest payable, it states that the company has not paid $100 of interest owed on its notes payable for the current period. So that amount is owed, and yet the payable says 0. So that means an accrual adjustment has not yet been made. We have not yet recorded interest expense and interest payable. So our balance sheet account would be interest payable, and the related income statement account would be interest expense. And the amount that we owe is $100. The next account is notes payable. This one-year note was taken out this year on December 1st. There's nothing to adjust here because on that date we would have received the cash and credited notes payable. The only thing that we would need to adjust for, we just did adjust for, and that was for interest payable on the note. Common stock, this amount was contributed for common stock in prior years. No adjustment recorded or needed there. Retained earnings, no adjustment needed there. Service revenue, $51,500. This is the current balance in that account, and it says most customers pay cash for lessons each time they're provided, but some pay in advance. And we know that because we saw this deferred revenue appear, and we did note that that has to be adjusted. The next account down is salaries and wages expense. It states here that employees worked through December 30th, but did not work December 31st. Oh, and you know what? We missed that account up here too. I apologize. We went right down to interest and income tax, and we totally missed this up here. It states at the top under salaries payable and wages payable that employees were paid $1,000 for 10 days of work through December 28th, but they have not yet been paid for work on December 29th and 30th. And as we look at salaries and wages expense here, it does say employees worked through the 30th, but they did not work on the 31st. So at this point, Golf Academy owes its employees for the 29th and the 30th, and yet no salaries and wages payable are indicated here. This is an accrual adjustment, something that has not yet been recorded, so we must record it. The question is how much? Well, the only way we can figure this out is to take $1,000 for 10 days of work and divide that to find out what 1 day of work would be. 1,000 divided by 10 equals $100 for 1 day, and we have to accrue for 2 days. So we'll multiply that by 2, and that means at this point, December 31st, $200 is owed to the employees. So the balance sheet account would be salaries and wages payable. I'm sorry, you can't see that. And the expense account would be salaries and wages expense. And the amount would be $200. Okay, let's see if there's anything else here. So we took care of salaries and wages expense that had not yet been recorded. We already took care of the supplies expense that had not yet been recorded. That was the first adjustment we spoke about. We took care of the interest that had not been recorded. That was the third adjustment. And now we're back down to that income tax expense, but now we're going to be able to calculate that, because what we'll do is take our net income and then add any revenue and subtract any expenses to come to our taxable income. So let's do this. Let's just put 13,000 here. That's our preliminary net income. And we're going to subtract any expense. So we'll subtract the supplies expense, and we're going to add revenue, like service revenue. Subtract the interest, subtract the salaries and wages, and let me get my ancient calculator here. And we will start with 13,000. Oh dear, it's not even recording. 13,000 plus 3 is 16,000. 16,000 minus 700 is 15,300. That would be our adjusted net income before taxes. And then what we'll do is we'll multiply that by our tax rate, which is 30%. So 15,300 times 30% gives us $4,590 in income tax expense. So our last pair of adjustments would be to the income tax payable account on the balance sheet. It's a liability. And on the income statement, income tax expense. And that would be for $4,590. Okay, now the first two adjustments I want to point out were deferral adjustments. There was something on the books, both the supplies and the deferred revenue, but it was not correct. The balances of those accounts weren't correct and they needed to be adjusted. The amount of supplies used up needed to be taken out. The amount of deferred revenue that had now been earned needed to be taken out and called regular service revenue. These last three adjustments were accrual adjustments. These were items that were not yet recorded, and our job was to record them. Okay, so now we have to do the journal entries for these adjustments. So let's take our journal paper. This would be the next page, part 3, and we would simply do our journal entries for those adjustments. So for the first transaction, we're going to record supplies expense and reduce the asset supplies. Expenses are debited to record them. This would be adjustment number 1. In the real world, we'd be using the date, December 31st, 2018. But here we're going to use the transaction numbers. So we're going to debit to increase supplies expense and credit to reduce the asset supplies. So by crediting that supplies account, it will reduce it. By debiting the expense account, that will reduce stockholders' equity and retained earnings. Our next entry is to record service revenue and to reduce the deferred revenue account. We reduce liabilities like deferred revenue by debiting. So we will debit to take out of deferred revenue the amount that has now been earned by delivering golf lessons during the month of December, and we'll credit service revenue. For the $3,000, and that will increase stockholders' equity. Our next entry is to record salaries and wages payable. Interest payable, I'm sorry. That's our third entry there. And we're going to debit the account interest expense for the amount they gave us, $100, and we'll credit interest payable since we have not yet paid it and it is due. This is a liability account. Our next adjustment is to salaries and wages payable, and we will debit salaries and wages expense and we'll credit salaries and wages payable. For the amount that we calculated, which was $200. And our last adjusting entry is for income tax expense. And we will debit income tax expense, credit income tax payable for $4,590. Now in the real world, we'd post those to our T accounts in our general ledger. In our problem, however, what they want us to do is to create another income statement, this time the income statement with those adjustments reflected in the accounts. So what I'm going to do is create another income statement right below here in part 4. If you recall, we had service revenue of $51,005, and now we're adding another $3,000 onto that. Now in Connect you won't be able to show the math, but here I'm going to show the math so that you know where I got the amounts from. The unadjusted trial balance said $51,005, but then we just added another $3,000 to that. So the total is now $54,500. Now for our expenses, the salaries and wages account previously was $36,100. but now we are adding $200 more to that account, so it becomes $36,300. Now our supplies account. Previously, supplies expense was $2,400. And we just added another $400 to that account. So our total of supplies expense comes to $2,800. On the unadjusted trial balance, there were no more expenses. However, we've added some expenses here. We've added interest expense of $100 and income tax expense. So let's add interest expense, $100, and income tax expense, $4,590. Our total revenues come to $54,500. Our total expenses come to $43,790. If we now follow our formula, revenues minus expenses equals net income, our net income is $10,710. Now they ask us, by what dollar amount did the adjustments in requirement 3 cause net income to increase or decrease? So if you recall, in our earlier income statement, the unadjusted income statement, our net income was $13,000, and after adjustments it dropped to $10,710. So $13,000 minus $10,710, the difference of $2,290 or $2,290 decrease in net income. So our income statement would have been incorrect if we would have issued the earlier statement. It would have been too high by $2,290. And that's it for this problem. Take care.